The Bangko Sentral ng Pilipinas is set to cut rates again this Thursday, tomorrow, even as inflation sits at a 6-year low and growth remains stuck at about 5.5%. The question now is, will cheaper money be enough to jumpstart the economy? Joining us now is Jonathan Ravelas, a senior advisor at Reyes Tacandong Company. Hi, Jonas. Good morning, and thanks for being here with us.
Good morning, Mikey. Good morning to your listeners.
Okay, let's start with two of the headlines from earlier in the newscast. Number one, BMI, a unit of Fitch Solutions, says that they expect the Philippine economy to post lackluster growth in the second half. Specifically, they expect growth for full year 2025 to expand by 5.4%, well below the government's 5.5 to 6.5% target. What are your thoughts on this, Jonas?
Well, basically, I guess the key factor really is all about the uncertainty of the tariff. This has actually, created a lot of businesses to stay on the sidelines as they wait for the impact of this to our economy. At the same time, you have to remember we battled inflation, and pure and simple. The man on the street does not feel it in his wallet when you talk about growth.
Correct. When we talk about GDP growth, our GDP growth, it's often cited as one of the fastest in Southeast Asia, second only to Vietnam. But why does this oftentimes feel like just a paper win? Growth on the charts, but it's not always felt on the ground.
Well, basically, I guess one is that it's not trickling down to everybody, unlike what we saw probably pre-pandemic, that people were seen to travel, consumer spending was at its peak at that time, and at the moment we're not seeing the growth to really filter down. So it's certain areas, particularly those that are just like a little bit of consumer that is actually moving, but the rest, they're feeling the hit.
Mm-hmm. This also has to do with the government's capacity to spend pre-pandemic and post-pandemic. And when we talk about this, let's talk about it in the context of debt to GDP ratios pre-pandemic and today. Pre-pandemic, we had a debt to GDP ratio of about 39%. And now, to put things into context, this administration, the Marcos administration, inherited a debt to GDP ratio of roughly 62% in 2022. And recent developments, they show that government's outstanding debt continued to breach records in Q2 of this year. Right now, we're at a 20-year high of 63.1%. The DOF's target was 61% by the end of the year. We're already above that. What does this tell you, Jonas?
Basically, I guess we understand that we are trying to recover just after the pandemic, and inflation eventually bit us in 2022, and we have to do two things. Given the present situation, we're doing fiscal consolidation. We continue to invest in what we really need, which is infrastructure, and at the same time hold off certain spending. However, given this battle in inflation, we've seen a lot of government subsidies that is needed to bring down inflation. So these are the challenges that the government faces today, and that also means the government has a lot of balancing act, and that's the reason why you're seeing sort of lackluster growth.
Mm-hmm. From an investor's perspective, does the disconnect between strong headline inflation and weak consumer sentiment make the Philippines harder to sell as an investment story?
Oh, definitely, because it's not really trickling down. I guess when you think about growth, you want it as inclusive. That means the biggest part of your economy, which is consumer spending or consumption, should actually be robust. But what we're seeing right now is that people are still managing their budgets because they still see prices quite high, and it remains fragile enough at this point in time.
Mm-hmm. Jonas, what would you say is the reputation of the Philippines as an investment destination today? 3 years into this administration, have you seen any meaningful shifts for better or for worse?
Well, basically, I think the Philippines is still a good story. It's just that there are a lot of headwinds at this point in time. We have a robust uh, consumption economy, which is domestic. So we should be immune from all of this. But because we import a lot, that poses the risk. Where our shift in trying to make our economy good is because of ATM, agriculture, tourism, and manufacturing, which are slowly, gaining traction. It's just that I guess on the manufacturing, it's just a question of further infrastructure spending that's much needed. And over the past year, we've seen the challenges for climate resilient infrastructures, especially due to the flooding.
Yeah. Jonas, on that note, you mentioned infrastructure and flooding. The president called out corruption in nearly 10,000 flood control projects since 2022. How does this cloud of infrastructure affect risk premiums investors assign to the Philippines? And do you think, if not the government, then who? If not the government, then the private sector. Do you think PPPs will help us change that narrative?
Oh, definitely. That would provide transparency, and at least, it's people will become more confident with the PPP. And of course, right now, people are looking for accountability, audit trails, so that confidence could be restored, and that well, initially, while we're trying to figure it out, maybe the PPP will take that portion of that spending. So hopefully that kicks in, so that slowly people will look at it as an opportunity to heal on the corruption side and focus on something that's more transparent.
Yeah, all right. Let's talk about interest rates. Tomorrow, the BSP's Monetary Board is going to be meeting to talk about interest rates. Expectations are for a 25 bip cut, baby steps this tomorrow, and then for another one by the end of the year. Given that we had one rate cut in the first half and we're looking at two this second half, do you expect momentum to pick up this second half?
Well, in a way, yes. You have to understand that policy cuts, the transmission of this takes around 6 to 9 months. So it's not as immediate. But you have to understand last year, we've cut by 75 basis point. And this is actually what could help, bring positiveness in the second half of the year. And given the present prognosis for inflation of probably hitting 1.5 on the average for 2025, that could actually, seal the additional 25 basis points probably in October.
Yeah. Okay, let's talk about inflation in relation to that. Headline inflation is at 0.9%, and core inflation is at 2.3%, levels we haven't seen in years. How sustainable is this downtrend, especially given all the external headwinds?
Okay, at the moment, we can probably say that it appears manageable, but again, it's still fragile given the fact that you have potential secondary inflationary effects from tariffication, and at the same time, potential currency volatility, which could create some effect. And you also have to think about the renewed geopolitical tensions that is happening in the Middle East. So that could contribute to higher oil prices. So at the moment, we can probably say that for 2025, 1.5% most likely in the bag. But moving forward to 2026, we can probably see it slightly hitting back towards the 2 to 4% range of the central bank, within the two.
Okay, going back to interest rates in relation to inflation, the Fed is expected to cut interest rates in September. This is going to give us more room to cut interest rates. The BSP has been in an easing cycle since 2024. Two more rate cuts baked into the cake. We already expect that. But moving forward, what's next? Are we still in the middle of this easing cycle with the Fed poised to cut rates in September? How much room does the BSP have to bring down rates further? And what's your outlook for interest rates for 2026?
Well, basically, I think for 2026, most likely we still have, with the Fed cutting by 50 basis points this year, most likely we could afford to cut further to around close to 4%. But I think on a conservative, we're looking at 4 to probably 4.25 for 2026.
And what does that signal for equities and bonds moving forward, Jonas?
Well, basically, I guess when it comes to looking at short-term rates, this will definitely mean positive for businesses. This will give them leg room to for expansion plans, and eventually for consumers, this should provide a little bit of leeway to their budget, especially when they pay their loans, housing loans. So this should at least provide cushion. But I guess in the direction of interest rates, given the fact that government is still expected to borrow for the 2026 budget, and it continues to rise, the challenge really is long-term rates could still rise further.
Yeah, talking about government borrowings, the government successfully borrowed billions of pesos through T-bills. Just yesterday, the government, the Bureau of Treasury, raised 25 billion as planned at Tuesday's auction. This was more than 4 times oversubscribed. So the government is taking advantage of the liquidity at present now, even ahead of the rate cuts. What are your thoughts on this situation, Jonas?
Well, basically, the demand for the treasury bills continue to highlight, despite the fact that we're expecting the BSP and the Fed to cut policy rates. It means that the strong demand for T-bills is that people are still expecting that long-term rates will rise. So what they're doing is basically staying on the short term and waiting for the rates to adjust. Then that's the time they lock in long-term investments.
Yeah, their liquidity is shifting towards safer haven assets, given all the uncertainties as well. Jonas, what's happening at the boardrooms, at the management level? What are companies doing in this type of environment? Can you help us understand what people are doing?
Well, given the set of uncertainties, some companies would tend to, concentrate on their core expertise, and we've seen this in the past year or so. Some companies adjusting their strategies, like the Ayalas, selling their utilities and just concentrating on their banking and real estate. That's one. The other thing is that they're also trying to build their war chest. They're analyzing their projects over the medium term and making sure that they're properly funded, and at the same time looking at risks. So it's really about adaptability to the current environment.
And from your vantage point and deal pipeline, Jonas, what's the biggest signal of where business confidence is today, given this changing environment and how everybody has to adapt to it?
Well, basically, I think at this point in time, it's really all about building liquidity at this time. Because once one good indicator is that if the middle class starts spending, that could be the beginning or a sign that the growth that initially we were talking about is lackluster, is slowly gaining momentum. So especially when we're now in the middle of the cycle of the accommodative policy, then definitely, probably towards the end of the second half, we have lesser uncertainties on Trump's tariffs. We hope that they're finished, and then we can move forward.
And lastly, Jonas, what's one piece of advice you can give to investors right now as they navigate today's environment?
Well, basically, I guess the one thing that they shouldn't do is not to invest. They should take advantage of the present market volatility to look into companies that provide good dividends and that are favorable in the medium term. And these are sectors such as food, retail, and real estate. And of course, you have to include infrastructure.
Of course. All right. Jonas, thank you so much for your time this morning. That was Jonas Ravelas, Senior Advisor at Reyes Tacandong.
Thank you, Mandy.